Hi, I'm David Silver, CEO of Instrumental Wealth. And joining me today is Matt Harbert, Chief Investment Officer. Today, we're going to talk through all of the key themes that we saw take place in the first quarter and some other things that we're paying close attention to for the remaining of the year. Matt, I'll go ahead and kick it over to you.
Thank you, Dave. So let's start with the biggest story of the quarter, the escalation of the Iran conflict. This wasn't just your standard everyday geopolitical headline. Instead, this triggered one of the largest energy supply shocks we've seen in decades. The conflict disrupted key infrastructure and shipping routes, particularly around the Strait of Hormuz, which carries about 20% of the world's oil supply. As a result, global oil supply dropped, prices spiked quickly, briefly approaching $150 a barrel before settling back down to around $100 a barrel. Why does this matter? Well, because higher energy prices act like a tax on the global economy. Consumers feel it at the pump, businesses see higher input costs, and overall growth expectations start to come down. So that brings us to inflation. Coming into the year, inflation had been improving. Then the energy shock hit. Oil and gasoline prices, which had been steadily declining, moved sharply higher, and that fed quickly into the headline inflation number. So you can see on this chart, if you look at the energy commodities, in December and January, prices were falling. But with the bombing that started in February, prices started reinflating again. And in March, we saw the full force of rising prices as they rose over 21% for the month. And it doesn't stop there. These costs will end up rippling through transportation, manufacturing, and even food prices. There is a real risk that inflation could move back above 4% if these energy prices persist. Moving on to monetary policy, at the start of 2026, markets were expecting a clear path towards rate cuts. But the events of the first quarter completely changed those expectations. This chart shows historical probabilities of where the market projects rates to be for the final Federal Reserve meeting in December. Looking at the table on the bottom of the chart, this shows that at the end of 2025, markets had expected rates to be somewhere between 2.5% and 3.25%. This would be about 1 to 3 rate cuts for the year. However, as of the middle of April, markets are now projecting rates to be either 3.25% or 3.5%, which is only 1 rate cut at most. Note that the probability of 3.5%, which is our current rates, are 70%. So the Fed is currently facing a dilemma. On one hand, inflation is rising again, which argues for a tighter policy. On the other hand, growth is slowing, and that argues for easing. These two forces are pulling in opposite directions, and instead of moving towards cuts, the Fed has shifted to a more cautious, data-dependent stance. So these events that occurred in the first quarter were one big chain reaction. The Iran conflict led to the energy shock. That energy shock pushed inflation higher, and higher inflation has limited the Fed's ability to cut rates. This combination has led to higher volatility across both stocks and bonds, as well as a much more complex economic environment to navigate. This also is a good reminder of why diversification is so important and how one big unexpected event can cause so much change in the markets and lead to results completely different than previous expectations. So moving on to the rest of 2026, geopolitics will continue to be an important issue, specifically what happens with the Iran conflict. Our base case is not a full resolution, but a partial de-escalation. And with this scenario, energy markets will stabilize somewhat. Oil prices will come down from peak levels, but stay a bit elevated. And we continue to see volatility caused by headlines. Next, we're also paying attention to equity market leadership. For the past decade, US stocks have dominated. This changed last year with the help of a big decline in the US dollar. Both international developed and emerging markets outperformed US equities. So far in 2026, international equities have continued to outperform, but the question is, will this continue over the remainder of the year? International markets have some advantages. Valuations continue to be more attractive, potential support from a weaker US dollar, and additional benefit if the US economy continues to slow. But at the same time, the US still has strengths, with a big one in its leadership in AI and technology as a whole. So we do think the most likely outcome here is that leadership will continue to broaden, but not a complete shift away from US dominance. But there will be more global participation. Finally, the US economy. Our base case here is for slower growth, but still positive, around 1.5 to 2.5% range. We don't think we'll be heading into a recession, but it will definitely be slower than in recent years. So overall, we're looking at a more complex and uncertain environment where geopolitics, inflation, and policy are all interacting in ways that can shift very quickly. And with that in mind, I'll turn it back over to you, Dave.
Matt, that's great. So to wrap this up, first, geopolitics has continued to emerge as a major market driver for the year. Second, inflation's no longer clearly moving lower. Third, the U.S. economic growth that we've seen is expected to slow. Fourth, the Federal Reserve is operating with even more constraints. And fifth, all of these will contribute to higher levels of uncertainty in markets. We believe that the current situation creates a more uncertain and more volatile environment than we've seen in recent years, which is really why, from a portfolio perspective, the key takeaway is that in this environment, diversification really does matter. Staying away from large, concentrated bets while being balanced across regions, sectors, and asset classes is likely the most effective way to navigate what's ahead. If you have questions around any of this content or material, please feel free to hop on our website and schedule some time with us. We'd love to have a deeper conversation with you around this. Thanks, everybody, and have a great day.